In 2005, one man bet against the entire financial system and won. 3 years later, Michael Burry walked away while others were still celebrating their paper profits. The market hadn't yet collapsed, but Burry had already seen enough. Why? Because he understood that when the numbers stop making sense, reality is only pretending to hold. At the peak of the housing boom, everyone believed the system was invincible. The banks were selling risk disguised as safety. The government encouraged it. Rating agencies sealed the illusion with AAA stamps. And the public, millions of ordinary homeowners, believed they were part of a prosperity that could never end. But beneath the surface, the foundation was already hollow. Debt had replaced productivity. Optimism had replaced analysis. Burry's spreadsheets told a different story. He saw loans being issued to people with no ability to repay, bundled into securities that no one truly understood. Every level of the chain depended on the next one not asking questions. That's how bubbles grow, through silence, not greed. The illusion of stability is the most dangerous product ever sold. And when Burry pulled out, before the collapse, it wasn't luck, it was logic. He saw that the same mathematical impossibility always ends the same way. When leverage exceeds trust, collapse becomes inevitable. Not immediately, but inevitably. Now imagine this: interest rates near zero, record levels of consumer debt, and governments printing money to sustain the illusion of growth. The names are different, the instruments have changed, but the pattern, the logic beneath, feels familiar. The same signals that once made Burry walk away are flashing again, quietly, relentlessly, beneath another wave of confidence. The mid-2000s looked like the triumph of modern finance. The United States was growing, unemployment was low, and the housing market was the national dream in motion. Every month, new suburbs appeared on the edges of cities. Endless streets of identical houses, identical loans, identical promises. To most economists, it was proof that deregulation worked. To investors, it was the age of easy credit. But beneath the optimism, something subtle was shifting. In the 1980s, banks made money by lending. By the 2000s, they made money by selling loans. Mortgages were no longer relationships between a banker and a borrower. They were raw material, and like any commodity, they could be sliced, repackaged, and sold again. That process created a new industry, securitization. In theory, securitization spread risk. In practice, it hid it. Thousands of subprime loans, high risk, low quality, were bundled into mortgage-backed securities. Investors around the world bought them, trusting the ratings, not the reality. When the payments came in, the machine kept turning. When payments slowed, the machine kept turning faster. The illusion of diversification replaced the discipline of due diligence. By 2006, the total value of mortgage-related derivatives exceeded the value of all actual U.S. homes combined. That was the paradox. The financial world had created more housing wealth on paper than existed in bricks and mortar. It was prosperity built from spreadsheets, not soil. Michael Burry, running his small hedge fund in California, was watching the numbers, not the headlines. He noticed patterns others ignored. Teaser rates expiring en masse in 2007. Credit default swaps priced as if risk didn't exist, and banks assuming home prices could only rise. The system was designed to reward belief, not skepticism. And Burry's skepticism became his weapon. To understand the magnitude of what he saw, we must remember what the financial world believed at the time. Central banks had tamed inflation. Mathematical models promised efficient markets. Economists talked about the Great Moderation, the idea that major crises were a thing of the past. It was a faith, not a theory. And faith is fragile when it meets arithmetic. In every era, there's a moment when finance becomes mythology, when numbers tell stories instead of truths. The early 2000s were that moment. Money was cheap, trust was infinite, and the global system rested on one assumption, that debt could expand forever. But as Burry understood, infinity is not an investment strategy. If this gave you a clearer picture of how it began, tell me where you're watching from. By 2007, the illusion began to crack. The first signs were small. a few mortgage lenders filing for bankruptcy, a handful of hedge funds reporting unexpected losses. Nothing dramatic yet. Markets still climbed. Television experts repeated that the subprime issue was contained. But containment in finance is a myth. Risk doesn't vanish. It migrates. The problem was structural. Mortgage-backed securities had been rebundled into even more complex instruments, collateralized debt obligations, or CDOs. Inside them, low-quality loans were mixed with slightly better ones, creating a statistical mirage of safety. The top slices, called tranches, were rated AAA. Pension funds, insurance companies, even local governments bought them. They weren't buying homes, they were buying the illusion of stability. Burry had modeled it all. He saw that when even a small percentage of homeowners defaulted, the entire structure would implode. It was like a tower built from mirrors, each reflecting value that didn't exist. To protect his investors, he began buying credit default swaps, insurance against the collapse of mortgage bonds. It was a bet that the system's mathematics were lying. The banks sold him those swaps willingly. They thought he was crazy. To them, it was free money. After all, no one believed the housing market could fall nationwide. The models said it was impossible. The word impossible is the most expensive word in finance. As 2007 turned into 2008, defaults multiplied. Foreclosures spread like cracks across a frozen lake. Suddenly, the bonds that were safe became radioactive. Banks stopped trusting each other. Liquidity, the oxygen of markets, began to vanish. In March 2008, Bear Stearns collapsed. By September, Lehman Brothers followed. The interbank lending rate spiked, credit markets froze, and what had been a housing problem became a global financial heart attack. Governments rushed to inject liquidity. Central banks slashed interest rates to zero. Trillions of dollars appeared overnight to prevent the entire system from dissolving. And yet, while most investors panicked, Burry had already left. He had closed his positions months before the full collapse. He understood that when a bubble bursts, even the winners can drown in the shockwave. The moment the logic proved itself, he walked away. The irony was brutal. The man who had seen it all coming was accused of sabotaging the market, but he hadn't destroyed anything. He had merely revealed what was already broken. That was the true event of 2008, not the crash, but the recognition that complexity had replaced comprehension. And now, 15 years later, complexity has grown even larger, while comprehension has not. The 2008 crisis didn't begin with greed, it began with engineering, financial engineering. The modern market had discovered how to turn anything into a tradable asset, even human optimism. Mortgages were no longer just debts, they were data points, millions of them packaged, layered, and sold. To understand what failed, we have to see how the machine worked. Imagine a mortgage, one family, one house, one loan. In a normal world, if the borrower can't pay, the bank loses money. Simple. But Wall Street found a way to disconnect risk from consequence. Banks pooled thousands of these loans together and turned them into securities. Investors bought slices of these pools, trusting that diversification would protect them. Here's the mechanism. When a borrower paid their mortgage, the cash flowed upward to investors who held the securities. When many borrowers defaulted, the flow reversed. It stopped. The system assumed that not all borrowers would default at once. That assumption was the hinge of the entire global market, and it was wrong. CDOs amplified the error. Instead of owning the underlying loans, they owned pieces of the bonds made from those loans. Then came CDO squareds, derivatives of derivatives. Each new layer was meant to dilute risk, but it only multiplied ignorance. The higher the abstraction, the lower the understanding. Credit default swaps completed the loop. They were insurance contracts, but without the requirement to own what you insured. It was like buying fire insurance on your neighbor's house. If it burned, you profited. The more houses built, the more insurance sold, the bigger the illusion of stability. Wall Street called it innovation. History would call it leverage. Every player believed they were hedged. Banks hedged with swaps, hedge funds hedged with CDOs, Rating agencies hedged with models. The problem? All the hedges pointed to the same event, the belief that housing prices would never fall everywhere at once. The entire market was one giant bet written in different languages. When defaults started, the machine didn't just stop, it reversed. The derivatives that once absorbed risk began to amplify it. One default triggered losses that cascaded through layers of contracts worldwide. Because the system was so tightly connected, failure wasn't local, it was instant. In the aftermath, governments stepped in, not because they wanted to save banks, but because the system had made banks inseparable from everything else. The complexity had become too big to fail, and too big to understand. What Burry exposed was not a crash, but a blueprint of fragility, a self-replicating design where profit depends on blindness. And that blueprint didn't die in 2008. It evolved. Today, the instruments have new names, the acronyms sound different, but the mechanism, the logic of infinite leverage built on finite trust, remains. When the dust settled in 2008, the damage was not only financial, it was philosophical. The system had collapsed under the weight of its own assumptions. And when assumptions break, money is not the only thing that disappears. Trust does. The losses were staggering. 8 million Americans lost their homes, over $20 trillion in global wealth evaporated, retirement accounts vanished, small businesses folded, and entire regions slipped into silent recession. But the markets recovered faster than the people. Wall Street was rescued, Main Street waited. Central banks stepped in as the new architects of survival. The Federal Reserve slashed rates to near zero and began a new experiment, quantitative easing, printing money to buy financial assets in hopes that liquidity would trickle down to the real economy. It was supposed to be temporary. It became structural. The invisible battery of debt was recharged. Banks merged, regulations thickened, committees were formed to ensure it would never happen again. Yet the paradox deepened. To save the system from leverage, central banks injected even more leverage, only this time through public balance sheets. Governments became the new borrowers of last resort. For ordinary citizens, the consequences were quieter but deeper. Wages stagnated while asset prices soared. Inequality became a feature, not a bug. The generation that entered the workforce after 2008 inherited a market permanently addicted to low interest rates. Growth from then on required stimulus, not productivity. Something else changed too, the psychology of risk. The crisis taught investors that no matter how reckless the system became, the state would intervene. It was the birth of moral hazard on a global scale. Profit remained private, loss became public. Every bailout signaled a new law of finance, that consequences could be postponed indefinitely. But postponement is not prevention. The debt remained. It just changed its address. From homeowners to governments, from banks to central banks, from private balance sheets to public ones, the burden shifted upward, out of sight. And beneath the recovery, the same logic quietly continued, that confidence could replace collateral and that infinite liquidity could outpace finite reality. Some historians call 2008 the Great Recession, but in truth, it was the Great Rehearsal. If this gave you a sense of what the cost really was, tell me where you're watching from. 15 years later, the scenery has changed, but the script feels eerily familiar. The characters are new. Tech giants instead of mortgage lenders, central banks instead of Wall Street, algorithms instead of traders. Yet the same belief drives it all, that the system can defy gravity if the mathematics are clever enough. After 2008, money itself was redesigned. Quantitative easing became a permanent oxygen line. Interest rates fell close to zero and stayed there for over a decade. Debt stopped being a burden, it became policy. Governments borrowed to stimulate, corporations borrowed to buy back their own stock. Consumers borrowed to maintain lifestyles that wages no longer supported. Growth was redefined as expansion of credit. Debt, once the problem became the cure. From 2010 to 2020, global debt tripled. Stock markets soared, housing prices rebounded, and economists called it stability. But it was an engineered calm, a calm maintained by trillions of printed dollars. When interest rates are near zero, risk loses its price. Every investment looks safe because the cost of money hides the cost of error. Then came 2020. The pandemic froze the real economy, and the same reflex returned. Print, inject, rescue. Central banks poured more money into the system than during any previous crisis. The result was predictable. Inflation, asset bubbles, and speculative manias disguised as innovation. Cryptocurrencies, meme stocks, zero-day options. Each was a new version of the same old illusion. Leverage had gone digital. And again, Michael Burry appeared. In 2021 and 2023, he warned of echoes from the past: excessive valuations, overextended credit, and blind faith in central banks. Few listened. They rarely do when optimism pays better than caution. But the data speaks louder than optimism. The U.S. national debt surpassed $34 trillion. Corporate defaults began rising. Consumers, once flush with stimulus cash, turned again to credit cards. The new subprime is not in housing. It's in personal finance, student loans, and government bonds. The collateral has changed, not the behavior. Then it was called securitization. Today it's called liquidity management. Then it was CDOs. Today it's ETFs and algorithmic trading. History didn't change, only the labels did. And the same dangerous comfort returns: the belief that the system cannot fail because it's too interconnected, too digital, too modern. That is the same sentence uttered before every collapse in history. The warning signs are not hidden. They are simply reinterpreted. When markets rise on liquidity instead of productivity, when profits depend on policy rather than innovation, when debt grows faster than output, the pattern is complete. Burry's logic still applies. The numbers don't lie. They just whisper. And right now, the whisper is growing louder. The last time Michael Burry sounded the alarm, few believed him. The data looked fine, the models were comforting, and the mood was euphoric. That is always the moment before the turn, when logic becomes lonely. Today, the same silence surrounds different numbers. Markets reach new highs while debt reaches new records. Politicians promise resilience. Investors call it innovation. Yet somewhere beneath the optimism, the arithmetic still waits. It doesn't shout. It measures. Every era convinces itself that this time is different. Every era finds new words for old risks. But mathematics doesn't care about vocabulary. Leverage, by any name, behaves the same way. It rises quietly and it ends suddenly. The lesson of 2008 was never just about housing. It was about blindness, the comfort of crowds, and the danger of abstraction. When money becomes too easy and accountability too abstract, the system stops reflecting reality and starts manufacturing it. That's when the smartest people make the same mistakes for the smartest reasons. And so, what made Burry pull out in 2008 is not a historical episode. It's a recurring signal. It appears whenever trust becomes a substitute for value, whenever complexity outgrows comprehension, whenever profits depend on disbelief. History doesn't repeat, it recalculates, and the equation is running again.